I'm Chris Preston,
I'm Brad Zimmerman.
and welcome to Street Check, the best podcast. Uh, no,
We get a
is that
Golden
fair,
Globe for
is that
podcast or
fair to
something?
say? Yeah. Oh, yeah, we didn't. Yeah, we got snubbed. What was it? The
Okay.
Amy Poehler one, I think.
Yeah, I
I
don't
listened to that one. It's not bad.
as a guy who's been listening to like podcasts for a million years and always liked, randos or like D-list Hollywood celebrities. I don't love the A-listers getting into the game. Like I don't want to listen to Conan O'Brien do a podcast. I want to listen
Yeah,
to
I
guys
like
I've
that
never
one.
heard of
That
and
one,
like
that one.
discover. I just like discovering new people.
Fair. I like both the Conan one and the Amy Poehler one a little less so, but I like them both. Not all guests are winners on those, but um. Anyway, they still both trail this podcast. Clearly, we were snubbed. Um, Brad, before we get into what we're going to talk about in the investing landscape today, you mentioned something very briefly. I said hold it for the pod. Something about you building a set for a Beetlejuice play right now. Is this something you're doing right now?
Yeah, so my daughter is in performing arts stuff. She does choir. That's why the Disney trip and the working at the hot dog stand,
Right.
actually taco stand. Um, and she's doing Beetlejuice, and I am one of three people that are working to build those sets. Um, in prepping for it, like I watched a bunch of the recordings of the Beetlejuice Junior shows that are available on like YouTube, and they all just do like a digital backdrop or a projector or something. And the director of their performing arts program really wants something that is going to like rival the the actual like Broadway production. So we have electronic actuators to lift people. We're putting in like a pass-through magic door and all kinds of stuff. It is I don't know. I mean, we're in the early stages. We've just put together a bunch of walls that we'll have to anchor, but we're gonna do like quick change stuff to uh flip stage assets on the fly. Um I don't know what he's going to do next year when my daughter is aged out of the school. The guy who is sort of in charge of building all the sets, his daughter has aged out, and when the other guy that's helping, when his kid has sort of aged out of performing. So they're going to be in trouble, but we'll let them go out on a high note with some cool Beetlejuice sets. We're going to do the weird sculptures and stuff like that.
When is the
Like
play?
like a month from now.
Okay. And what's your daughter? Is she a big role in it?
She's a speaking role, but not a big
Speaking
role.
role. Okay.
I'm
Speaking
not
role.
going to disclose she was disappointed with the role that she got.
Okay.
Uh, but
Speaking role's good though. That's something.
yes,
Yeah.
yeah, and she gets to sing Deo with
Oh, nice. Yeah, yeah. Of
so it's sort
course.
of an iconic moment.
It
And the
is.
play is good. We saw it when it was touring, and it's going back to Broadway, or it's going to Broadway now. It had been off Broadway previously. If you get a chance, it's and you like theater at all, go see it.
Yeah. Filmed in Vermont, both first one and second one. Fun
Oh
fact.
yeah, I forgot you had that sort of loose Beetlejuice connection.
Yeah, that can't remember the name of the town. It's not that close to me. I mean, everything in Vermont's fairly close, but as far as Vermont goes, it's not that close to me. But it was a whole deal. They built the house there, whatever. The first one 40 years ago, whatever that
Yeah.
was. Yeah. Um, okay. What are we going to talk about today, other than Beetlejuice?
We are going to talk about bank earnings. So, earnings season is starting once again. It's that time of year, and we're getting sort of mixed results from the big banks. We can talk about Jerome Powell and the DOJ and the market's reaction to that. We're going to talk about BYD maybe getting more of a foothold in America and North America more generally, but in the US specifically. And we're going to do a jump ball segment and just go head to head on stuff we like, stuff we don't like, etc.
But before all that, as usual, defend the take. And Brad, you're up this week. Yeah, your take for this week, for you, which you have 90 seconds to defend yourself, is that inflation is actually double the CPI print tally, but only for the stuff that you really want. That again, you have 90 seconds. Go.
Okay. So I talked a couple of weeks ago about like how being heavily in cash is a bad idea. And I continued my money supply spiral. Found a paper out of Texas A&M that was written by a math student with like under his professor, right? So it's the math is good. They found that M2 money supply growth was close to about 6.2% annually versus stated CPI in the twos and threes, right? And this is going back to 1970. They found in that paper that the equivalent sort of median household income, if you adjusted it for money supply growth instead of CPI growth, would have been 216,000 as of 2020. The the important takeaway is that the M2 money supply growth, so the printing and spending that central banks do, that governments do, that only really triggers asset price inflation. So gold, stocks, hard assets, real estate, things like that. It doesn't fully trickle down to the CPI. So the CPI, right, you take advantage of productivity gains. There are pressures from the other direction from like affordability. So like the cost of beef can't rise 6% every year. Nobody would ever be able to afford it. But the important takeaway is if you are competing with asset-rich households for something, or if you hope to buy assets yourself, you can't project out the value of those assets or what that asset will cost you based on the CPI number. You can't look at a house that right now that's $400,000 and say, I want to buy that in 10 years and I'm going to assume it goes up 3% a year. No, you need to assume that the value of an asset that is highly sought after is going to rise closer to 6% a year. That's going to be true for college education as well,
Okay.
because asset rich households are competing with asset poor households. It is also a reiteration, own assets. Own assets that give you returns. Otherwise, you are gonna fall behind.
Okay. Good take. I mean, what like give an example of, asset that you think, I guess you mentioned housing. Is there any other that sort of come to mind, spring to mind?
So this one, I think this is maybe a good illustration of um, where you have a little bit of play between like the price of goods and the price of an asset. So the
Hmm.
average new vehicle in 1970 was uh, starting prices were around like $2,500. That's about $29,000 today, right?
Yeah.
It's not an appreciating asset, but that's sort of consistent with what a lot of starting prices for vehicles are. Something that is highly sought after by asset-rich households is going to be something like a Corvette. A Corvette in 1970 was $7,000.
Yeah.
The CPI adjusted value of a Corvette or price adjusted, or excuse me, CPI adjusted price of a Corvette is going to be closer to 59 to 60,000, but the starting prices are 70, 90, or 100,000. Um, if you are competing with asset rich households for limited assets, they can pull the price higher. That largely explains why the cost of college education is actually, if you adjust it based on the M2 money supply growth rate, is really unchanged over the last 55 years.
Hmm.
It's astronomically more expensive based on than the CPI growth rate is, but it's in line with where it was based on money supply increase. And that's because the cost of an education is dictated partially by who can afford to pay it because there are fewer college seats than there are people that want to go to college. So the asset wealthy households, the asset rich households can pull the price up at the expense of the people whose income increases are coming from wage growth, which is typically closer to what the CPI number is. It's the K-shaped economy thing we've talked about. It's the bifurcated economy that we've talked about. The it is I th it's there's not like one like grand takeaway other than if you're going to be competing for assets, so real estate, gold, um, anything that's highly desirable, or something that asset wealthy households are going to be trying to acquire. Could be travel,
Hmm.
second properties. You need to be in their space. You
Yeah.
can't rely on the income generating potential of your labor alone. You need to own hard assets. One of the base case from I was reading an article from Vahan Roth. He's a CFA out of Switzerland. His base case is that this is our normal. We will continue to see central governments print money. Will continue to see spending rise. What we have been experiencing, especially, which has been just super visible since COVID, but it's been happening since the 70s, is this continued growing bifurcation. If you are not in the asset growth side of the equation, you are going to fall behind. And if you're going to want to buy a house in 10 years, your expected returns that you need to generate to achieve that need to be more in line with the asset growth, the asset household, than it is with the sort of wage earning household. So it really it's most valuable to reinforce you should be invested, you should own appreciating assets, and if you're trying to plan out over a longer time horizon, you can't use just something like a CPI or a goods inflation as your baseline for cost increases. If it's a desirable asset, if it's something where you're competing with asset rich households, you're going to want to assume that those costs are going to rise much higher.
All right, good take. Bit of a thinker, but I like how you explained it. Well, speaking
Yeah,
of,
I
uh, what's that?
I was in a M2 money supply spiral and couldn't get out of it. So
Okay.
apologies to anybody that feels overly subjected to M2 money supply talk.
Okay. It's not quite quivets, but no, it's good. Okay, let's shift to the market. So earnings season kicked off, Q4 earnings season kicked off this week with the banks as usual. Banks are a little more mixed than I think they've been recently. JP Morgan kicked off by missing earnings. That was on Tuesday, I believe. And Bank of America, Citi Group, and Wells Fargo all also fallen short of expectations. But Morgan Stanley and Goldman Sachs did quite well. Morgan Stanley earnings up or profits up 18% year over year. Goldman Sachs 12%. And the difference, as explained in a New York Times article out the other day, um, banks that do business largely with rich individuals and corporations, such as Goldman Sachs and Morgan Stanley, fared comparatively better. And the results from, major lenders, were a little more mixed. The troubles kind of range from JP Morgan had delayed merger deals, high expenses or expenses remaining too high for Citigroup, inefficient AI tools for Bank of America, sort of a mixed bag. Do you take anything, do you take much away from that? Do you see this as much of a red or yellow flag, banks being kind of mixed for the economy, or do you think it's a bit of a case by case basis type of thing?
I mean, I do think that that is well timed coming after my jag about asset rich versus
Right.
like income earning. Um, yeah, Morgan Stanley had their M&A, their investment banking division was up 47%.
Hmm.
The income was year over year because of strength in their M&A. We have Nancy has written, Zambell has written about this, and Tyler London's also written about this. M&A is picking up. Um, Part of the reason that M&A is picking up is because it's an asset grab, it's asset acquisition. Um, the banks that operate in that space, I think, continue to do well this year. Your Morgan Stanley, your Bank of America. JP Morgan historically has done pretty well with like newly public issues and stuff like that, but their trading desk is I don't think as robust as Morgan Stanley or Goldman's. But they were sort of JP Morgan, I would say, is probably more of a one-off. They estimated that their expenditures, I think, for tech modernization were going to be like 105 billion this year. So their total expenditures they estimated at 105 billion this year. That's up from 96 billion a year ago, and they said tech modernization was a big part of that. Um, I wouldn't be surprised if most banks saw some tech modernization because apparently the AI tools don't play very nicely with like these legacy bank systems, many of which have been in place since the 80s and 90s. So
Hmm.
the modernization is going to be there. JP Morgan also had a credit reserve of 2.2 billion that they had to account for because they're taking over the Apple Card um, portfolio. I don't remember who they're taking that from, but they're going to be the sort of backstopping bank behind Apple Cards, and that cost them a little bit. But I think the takeaway is you want to own investment banks more than you want to own retail banks, and I think regional banks are really going to tell the story of
Yeah.
whether this is going to be an ongoing problem or whether it's sort of a one-off. But you want to be involved with the companies that are working with big companies, wealthy homeowners or wealthy households, more so than you do with banks that are going to be working with uh, lower income consumers, because those banks are also going to have to do the tech modernization thing. Probably not to the scale of like JP Morgan, but look to regional banks. That'll give you your tell, I think, for the rest of the year.
Yeah, yeah, it's nuanced enough where like I don't see it as necessarily an ominous sign really for the economy. Um, like in like Bank of America's case, eh, Brian Moynihan, their, you know, CFO was being grilled about why their expenses are still so high, and just by trying to improve efficiency and growth being a little bit slower than expected, but he seemed, at least sounded confident that they would, get back on a streak, is how he put it. We'll see. You know, I Yeah, clearly being an investment banker is or investment banking heavy is a better place to be right now, given how the market's done and given, that money is still generally pouring into the market, you know, despite sort of the meh economy. Um, Yeah, I don't know. I think you're right that the regional banks will probably be more of a tell. I saw M&T Bank, which reported this morning did well. But we'll know more probably in the coming weeks. But I don't know. I don't see even necessarily a yellow flag in this yet.
Yeah, I don't think this is like canary in a coal mine.
Right.
Bank of America, what fell 6% in the last 5 days. I haven't seen
Yeah.
what they've done this morning, um, but I don't think it's like the tiny rock slide right before an avalanche. I think it's just um, picking favorites is
Hmm.
probably is maybe more the way to go. Um,
Yeah.
but but we'll see.
Yeah. Yeah, Bank of America, it's up slightly this morning. Yeah. They all the ones that missed sort of got punished a little bit, 5, 6% or whatever. We'll see how they behave in the coming weeks. Okay, let's move on to even more of a macro discussion. So, what was it, last weekend that it came out that the DOJ is investigating Jerome Powell for, I don't even remember the reason, the
For
stated
con
reason.
conduct concerning his testimony to Congress about the cost of the remodel of the Fed headquarters, which,
Right.
if you recall, sometime in the fourth quarter last year, he was like on a tour with the president,
I
and
remember the hard hats. Yeah, it was awkward.
the hard hats, and
Yeah,
he corrected the president
that's
on
right.
air and said, "No, this is in this line item. If you look here, we're actually sort of in budget on budget." I mean, it's the first time it's ever happened, so it's unprecedented. Powell had a equally unprecedented response. He said, "These are," I mean, he said this is all just targeted at the Fed's decision to
Hold rates.
manage manage rates based on what's best for the economy and not what the president wants.
Right.
Um,
And Wall Street, so the point was Wall Street that next morning, it was Monday morning, right? Stocks fell somewhat, not precipitously, but somewhat sharply. They're down 1% or more. And then as usual, there wasn't really um a well publicized backtracking, but you notice that like you haven't heard a whole lot about that investigation since then, and markets have kind of come back to life now. They're, as we talk, they're right back near all-time highs. This has been a pattern where the Fed or Powell himself, usually Powell himself, has been threatened by the president over the last year. What was it? There was one point where Trump said, his termination cannot come fast enough, and the
yeah,
markets really didn't like that and retreated. The point is, the market right now likes, trusts, whatever word you want to use, Jerome Powell more than it likes Donald Trump. And anytime that Powell gets threatened, now granted, he's going to be his term ends in what, June? Is that right? June?
May.
May. We're nearing the end here, although there's talk that, maybe he'll stay on as a member of the board, which would then prevent um a new member from taking, is that right? A new member from coming on or being appointed. Which hasn't happened in decades, but could happen. But anyway, his term as Fed chair ends in May, but it's clear the market trusts him, and why not? The Fed has, while they botched the whole um back in 2022 when they said this was it wasn't temporary,
Transitory.
transitory. Yeah, thank you. Transitory inflation. That was wrong. But most of the moves they've been made since then to get inflation down from 9% to below 3, um, and to hold rates steady as long as they did, and 3 cuts last end of last year, 3 cuts end of the year before. I think they've earned the market's trust, or he's earned the market's trust across both Trump and Biden's presidency. So therefore, the market seems to trust him and doesn't like anything that would upset any meddling in what the Fed's sort of methodical plan is here. Is not taken well by the market, and hasn't stopped the administration from trying to rattle Powell or the Fed, but every time they do, market doesn't like it.
Yeah, we've had nits to pick with Powell and with the Fed, and we've had our
Hmm.
like share of criticism, but it's all like Monday morning quarterbacking.
Yeah,
It's not it is not us saying, "Hey, put us in, coach, because we're going to play better than Josh Allen." It's like, well, Allen probably should have made this throw, or he probably shouldn't have.
right.
He probably should have looked off the middle linebacker or something. Right? Like our criticism, I think, has typically come from a place of uh, respecting the process and sort of understanding how they're reaching certain conclusions, and is maybe a little bit more nuanced. But when the most powerful person in the free world says you're doing a bad job and we need to get rid of you so that we can hammer rates lower, that's a much different level of criticism. Obviously, like the market isn't cratering because of this, so I don't think
No,
that the market is pricing in an expectation that this will go anywhere.
right.
I think most participants are assuming it's bluster, but we should actually hear from the Supreme Court relatively soon about whether or not the president can fire somebody like Powell or another board governor. And if that happens, then
Yeah,
they force rates lower, and that's when we get a redux of that consumer inflation that was really so painful because money becomes so much cheaper and easier, and asset values will rise because of it, at least in the short term, as long as nothing breaks.
yeah.
Um,
We'll see if
but
we get that Supreme Court ruling anytime soon. We're still waiting on those tariffs, that tariff ruling.
yeah, they
Right.
keep kicking that can. I think they're going to let these stand.
I think the more that they kick that can, the more it seems like they're going to let them stand. But
Just
yeah.
it's not because like the reasoning is good. It's just such a pet project.
Hmm.
And they've done that before where they've been like, well, in this case, we'll. we're not going to interfere with the existing policies, but going forward, you can't do that.
Right. Um, yeah. So, I mean, I don't know what the takeaway is. Well, it'll be interesting to see when Powell's term ends, how the market reacts to that. Especially if he, doesn't stay on. A lot may depend on who takes his chair. But that's 4 months doesn't feel like, very far away, but these days it is. We'll see if there are any cuts between now and then.
So
Uh,
I'm glad you brought that back up because, having just talked about JP Morgan and now talking about the Fed, they actually came out earlier this week and said no cuts in 26, hikes coming in 27. Um,
hmm,
that assumption is obviously premised on the president being unable to fire Powell and then install a sort of hand-picked board that's going to jam rates lower. Um, I I don't I mean they also said 5 cuts or 6 cuts last year,
JP
so
Morgan, I feel like is way off on this all the time.
yeah.
Yeah.
I don't know. I don't the other thing that you have to consider, I guess, is the Fed going to be more likely to hold rates steady through at least the end of Powell's term if there is an assumption that when he moves on and then maybe there's board appointments that rate cuts will be coming hot and heavy. So if they
Yep.
can keep rates higher now, it'll maybe moderate some of the damage from
Right.
cutting too fast later.
To your point, I brought up the CME Group Fed Watch tool, which we always cite. It they've really the expectations of a cut have really been pushed out. Actually, it's now to June, which was
Yeah.
before it was like March, April, and June would be after Powell's term expires. 95% chance they hold this month, which I think that's everyone's pretty much agrees that that's going to happen. Up to 78% in March, and now 65% in April.
That they
The first
hold.
that they hold. Um, it's 44% chance is uh the majority in June, with another 15% thinking that, there'll be two cuts by then. But, that's up from, I mean, I think even when we talked, was it last week? We sat here and talked that at that point, more than 50% thought that there'd be at least one cut by April, and now it's 65% think that there will not be. Um, Yeah, it says one month ago it was 34% thought that there'd be no cuts by April, and now that's 65%. So you may be right that they are just going to hold sort of like they've done the last 2 years. I mean, each of the last 2 years they've held until September. Maybe this time it's just holding until Powell is out of there, and like you said, just preparing for some Trump appointed person taking that spot and slashing rates too quick. But if you hold them
or
through most of the first half of this year, then the damage may be limited.
or bulk firing like Fed member.
Who knows? So it's hard to speculate on that.
Yeah. Yeah. And it'll come down to the court. It'll come down
Yeah.
to the court's interpretation. So I think the takeaway is that don't overreact to threats. Um, Powell Powell's a consummate professional. It's weird that he's getting threatened by the president, but he is in high stakes situations that dictate the path of the global economy every single day. So he can weather this storm. So I wouldn't overreact to threats, but uh, if we get like blanket firings,
Right.
that's when volatility hits. That's when people are going to start appropriately reacting.
Well, I wonder if, and just last thing before we move on, I wonder if, Trump loves the stock market and sees how it reacts. And if it keeps reacting, it has kept reacting, negatively to any threats towards the Fed's sort of stability. So I wonder if, mass fire, if he, I would hope he would know at this point that just mass firings of the Fed would not go over well with the market, but who knows?
Yeah, you'd hope that.
Yeah. Okay, let's move on to something a little less macro. Number three in our big three, BYD, one of my babies, the Chinese electric vehicle giant. It does not have heretofore has not had any American presence, and it still won't. But it's in talks for a hybrid battery deal with Ford, American company, which would use BYD in batteries in cars outside the US. The appeal for Ford is they're looking for cheaper batteries they're in cost cutting mode and more advanced tech. BYD sells cheaper batteries, and it's sort of an effort to scale back their EV costs, especially after tax credits on electric vehicles expired. Demand, especially here in the US for EVs, is down. And so, this seems like it might be good for BYD. Who knows for Ford? I wonder if I ended up to you because I got something in my throat, but I wonder if this is the first step towards BYD getting a foot in America.
North America, I mean, I think it's the first of several steps. We had Canada just reached an agreement with China earlier today that will impose a 6.1% tariff on imported electric vehicles, and it's going to cap that at 49,000 vehicles in total. So that's progress in two North American markets. Um, I am very skeptical that that will translate into us seeing BYD vehicles on the streets. Um, there is there is so much conflict trade wise between the U.S. and China right now. Obviously, they are subject to really high tariffs already, and that's for things that ostensibly we need. Something like this, which we don't need, and which directly competes with American products, um, and potentially impacts American jobs as well. Like we had a battery deal with what Hyundai Kia until there was DHS action that maybe put that on the back burner a little bit, or at least raised conflict there. I mean, like that would be the thing I would be worried about if I'm Ford, is that um the immigration policies and stuff then are in conflict with that partnership. It's an added layer of friction that, otherwise you would definitely hope to avoid. I don't think we see BYD cars in the US unless they're like visiting from Mexico or Canada.
Right. Yeah, I think this could be laying a bit of groundwork, striking a deal with Detroit, laying a bit of groundwork for, say, 2029 under a new administration,
Yeah, maybe.
a more China-friendly administration. I don't know. It may just be an opportunity that they found for their batteries with a big American company. And, the fact that it's American is less strategic. But maybe it's moved the needle with BY stock a little bit. And we're going to talk BYD a little bit more in a second. But yeah, I thought it was just interesting since BYD has, avoided America basically until this point.
Yeah, they're right now they're getting heavily subsidized by the Chinese government. I I would think most of BYD's components, so frame, chassis, internal stuff like that, I would think it would be much cheaper to build in China. I don't know why they would be permitted to then you to like develop battery tech and build battery tech in the US unless maybe it's like lithium related. I know we've got the Lithium Americas and there's the what Mountain Pass. So maybe there's like a resource maximization angle to it that I'm missing. But I would think in general it would be that BYD would be more inclined to just keep producing batteries where it's cheaper in China, where labor costs are lower, and then shipping them to the US and having US buyers eat the tariffs. Like I can't imagine Ford is saving much money versus going that route.
Yep.
Um, or maybe maybe it's a technological generation thing. I know Ford has been struggling with their EV unit for a long, long
Yes.
time. I think they lost $1 billion on the
Yeah.
F-150 Lightning last year. They
Yeah.
make a they make a great EV. My wife has the Mustang Mach-E, and it's fantastic. It drives like a go-kart. Um, but it hasn't been profitable for them. So they're, but you also said they're hybrid batteries, so I guess that I don't know. The,
I think
the
a lot of these US companies especially are leaning more into hybrids because hybrids are more popular here than pure EVs.
thumbs down. My hybrid, I would much rather drive the pure EV than the hybrid. But
I like the hybrid. We have a Volvo XC90 Recharge and it's great. But I also don't have a pure EV to compare it against. So
yeah,
yeah. All right, let's move on. And we're gonna get to our jump ball segment in just a second. First, let me tell you about the deal that we're offering today for today's listeners. If you go to cabotwealth.com/street, we are offering our flagship newsletter, Cabot Growth Investor, run by Mike Santolo, who's been on this podcast many times, has been with Cabot for 26 years now and running this newsletter for nearly 2 decades. Cabot Growth Investor, we are offering it for 1 year for $99, which is well off the $497, the normal $497 price. Or you could also get it for 2 years for $497 or 5 years for $1,235. That is 50% off the normal 5 year price. There's a 30-day money back guarantee, and you get twice monthly issues with new picks. You get weekly updates on the non-issue weeks, frequent trading alerts. You get free stock reports, how to handle monster stocks for maximum profits, 10 rules for big profits and growth stocks, 7 ways to build and protect your wealth. And also, you get access to Mike. Mike gets lots of emails, and he's great about getting back to people. So, again, go to cabotwealth.com/street. We'll have a link to it in the write up on our YouTube page, and you get $99 for 1 year. Really good deal for one of our best performing newsletters and really our flagship newsletter. Okay, let's get to jump ball, and for that we're going to bring on the voice of God, our producer Madison Robertson. Madison, you there?
Good morning. Yes, I am.
Yes, great. Good morning. Thank you for doing this despite being 8 months pregnant, 8.5 months pregnant.
I don't, whatever 37 weeks is.
Wow.
It's so much fun. You forget, it's like, do you guys have tattoos?
yeah,
No.
You like forget the pain of a tattoo. So you just go back and get like more and more, you know? And that's where I'm at. I forgot. I forgot what the last few weeks was. But it's okay because it's going to be great and it's all worth it and all that stuff. So thanks for making me not be on camera for this.
Yeah. Well, I figured, this will help ease your pain a little bit.
It does. It does. When
But
people are like, how did you have a pain-free pregnancy? I'll say, I just produced the Street Check podcast.
yeah, and red jump ball. Okay, so just to explain jump ball, we pit two things against each other, and we say which we think will do the best. The timeline I set here was basically just 2026, which will do perform better this year. So we have several items. So Madison, I'll let you read the first one.
Okay, first one, Bitcoin versus gold in 2026.
ooh, that is a tough one. Um,
I'm gonna say
I
Bitcoin.
Bitcoin. I'm inclined to go gold, although I think precious metals are having a rough day today. Although all the attention is on silver right now, right? Like silver ran up to $93 an ounce, I think, spot price, and there's a lot of credible claims that it hits 100 or maybe even higher. Meanwhile, gold is not getting any attention, but it's still over $4,600 an ounce. Um, Bitcoin, going back to that sort of asset thing, I don't think of Bitcoin as a return generating asset. And maybe the market disagree. The market has disagreed with that for 15 years or however long it's been available. But given sort of my baseline assumptions about what the economy looks like and what this year looks like, I will go with gold to outperform Bitcoin.
Yeah. I mean, I'm, me selecting Bitcoin goes against almost everything I stand for, but but we've talked about how, I think Bitcoin is a bull market play. I think the bull market will continue for most, if not all, of this year. Bitcoin topped out at 124, 125,000 in early October, dipped as low as 84,000 in late November. It's up to 94, 95,000 now. But, I think the market will rise to new highs, and Bitcoin, its only utility, I think, is as a bull market play. As the market rises, so will Bitcoin. In fact, it's started to already. And like you said, gold is already at 4,600 an ounce, I mean, that's up from, let me look, what is that up from in the last year? That's
So
not quite double, but up from,
60, it's up 67% in the last year.
yeah. So this time last year, it was like 27.46 an ounce. Um, I think gold will continue to rise. I just don't think it's more in Bitcoin's nature to rise fast in bull markets than it is for gold, despite all the weakness in the dollar and all the, you know, turbulence necessitating it being a safe haven for people. I think I could see gold rising another, say, 30% this year, but Bitcoin rising, 50% plus this year before cratering. I mean, if we were doing this over the next 2, 3, 5 years, I'd say gold for sure. Bitcoin this year, I think outperforms.
Yeah, I mean, we're 2 weeks into the year, Bitcoin up 8.5% year to date. Gold is up 6.2% year to
Mm.
date.
Yep.
Um, a 30% rise would put it at 6,000 by the end of the year.
Yeah.
That doesn't strike me as like out there, right? Like that seems like a feasible path.
Yeah.
Gold, I mean, especially if rates get hammered. If the president gets his wish and rates go down to near nothing, gold loses competition from yielding assets a little bit. I mean, that's sort of in the margins, but money printing continues. Gold, yeah, I don't. I like your sort of assumption about gold. Um, I'm just concerned. I'm concerned that the tech, because of the high correlation between tech and Bitcoin, that if tech runs into a rough spot, the people that are on margin that bought Tesla, Nvidia, that bought Microsoft, Apple, Google, like those are the people that also own Bitcoin.
Mhm.
So if you need to start paring back your exposure, you also sell some of the Bitcoin. I think that is the only thing that has me thinking gold outperforms.
Okay. Well, we're on opposite ends of the spectrum on this. That's a good start. All right. What's next, Madison?
US stocks versus European stocks.
It's a close call. I I think I'm going to say European stocks. Um, there was that period beginning of last year when tariffs were a real issue, where European stocks were outperforming U.S. stocks by a wide margin. Um, it ended up being uh, they're a little bit more in lockstep last year. I think, it goes back to just the sort of global rebalancing thing that Carl has talked about when he's been on
Yeah,
here, Carl Delfeld. Just, the US has, I can't remember, what is it, like 70% of the, it accounts for
market cap,
70% of the global market, despite being what?
25% of GDP or something like that, right?
25% of GDP and like 4% of the world's population.
Yeah.
Um, I think just sort of I think that's sort of like a macro trend that I think will continue with people shifting their money overseas as more, overseas opportunities, um, surface. And also, European in much of Europe, their central banks have already cut rates faster. The rates are lower than US. Now, the US may really play catch up second half of the year here. But we've talked about we could see US stocks being up, in the 10% range this year. I could see European being more like 15%. What say you?
I think in the aggregate, I'm going to give it to US stocks.
Okay,
Um,
good. Disagree again.
I'm not going to be stunned if like the Nasdaq closes flat for the year. Um,
Yeah.
right. We're seeing a lot of rotation already. We've actually seen a ton of rotation into emerging markets early
Yeah.
this year. That would tell me that either investors are seeing like the risk of being in emerging markets, or they're seeing, hey, we've had good returns from international. We want to up our risk exposure to international, so we're going to look emerging markets. Or the flip side of that would be that most of the easy money has been made in the other sort of like first world European countries. I really like small caps in the US this year.
Yeah.
I don't love large caps, and I think it's just sort of how those numbers shake out specifically. I think US markets and European markets are going to be very close in end of year performance. And if I could get more specific and say, well, like US small caps, I like over European large caps, but I don't like as much as like emerging market. If I could do that, I probably would. But given that we are simplifying it down to just US or large cap or European, I think I'm going to go with US. I just think the small caps have more room to run. And they're going to be sort of overrepresented in the total performance versus the emerging markets, which are going to be underrepresented in total performance. And I do think the great rebalancing trend continues, but I just think that I mean, European stocks were up like, or global stocks were up like 30% last year. I think that
Yeah.
easy money has been made. It's going to be tougher, and I think it'll be neck and neck all year, but I'll
Yeah.
side with US stocks.
And going with the neck and neck theme, so over the last year, so measuring from today, not exactly, just limited to 2025. S&P up 17%, stocks Europe 600 18%.
Yeah.
So almost neck and neck. Okay, what's next?
More than one rate cut versus one or fewer rate cuts.
I'm gonna say more than one.
Yeah, I'll agree
Like
with
we
you.
talked about, I think even if the Fed slow plays it, and we've seen 2 years in a row, we've seen them slow play it until September, and then they sort of put their foot on the gas and have cut 3 times. Obviously, now there's fewer cuts, rates aren't as high as they were, so it's less of a necessity to, slash three or 75 to 100 basis points or whatever. But one way or another, I think we're getting more than one.
Yeah, I don't like that I agree with you, but I agree with you. I think it's,
Right.
for the wrong reasons that we're going to get these rate cuts, but also just leveraging that JP Morgan counter indicator. They say no cuts and they tend to whiff. So I'm going to go
Yeah.
with more than one cut.
Yeah. They have really whiffed. What are they doing? These are just wild takes. Is this a bit? I don't.
I I would guess they just have 10,000 analysts and they're like, well, this one guy says there's no rate cuts, and that's what picks up headlines. But then they have 40 other analysts that are all saying, no, we probably get two or three rate cuts, or we get one. Like I don't know.
Yeah.
It's probably how it filters through the media more than anything else. I mean,
Yeah.
they're a massive bank. They've been incredibly successful. So they're doing something right. It's just
I know. But when
not
it comes
telling
to interest
people how many
rates, they're
rate cuts.
like Kathy Wood, Michael Burry levels of wrong. You know?
Yeah.
Uh, so yeah, I like that going with as a counter indicator. Okay, what's next?
BYD versus Tesla.
Uh,
I'm gonna stick with BYD. I can't give it. This is my bit. I can't give it up now. We just talked about it. Not because of the Ford deal, but BYD just surpassed Tesla as the top EV seller in the world last year. Um, and yet the stock trades at what, like 15 times, it's like 15 times cheaper on a price to earnings basis. It's down sharply from, topped over 19 a share last May. It's now in the, 12, almost 13 per share. It's stabilized. Not that Tesla had a great year last year, but it's closer to its highs than BYD is. And, BYD grew sales by, I think it was like 28% last year, whereas Tesla's sales were down 9%, I think, at least on a deliveries basis. So I like the upside with BYD much more than I do with Tesla.
I'm not a big Tesla guy. I have criticized how they're valued,
Hmm.
but I'm going to go with Tesla.
Okay.
Um, the big, so one of the things that has sort of come out in the last couple of days is that they may ultimately forego IPOing SpaceX. Uh, and if they forego IPOing, there's chatter that they may do like a reverse merger with Tesla. Um, and there that is enough to sort of outpace any kind of fundamental weakness. Um,
Right.
if
Trading, it
there's
trades at 196 times forward earnings versus just 17 times forward earnings for BYD. Speaking to, fundamental weakness.
Yeah, so if SpaceX essentially comes public and is simultaneously merged into Tesla, that probably that jacks Tesla's valuation by 800 billion at least. I think that was the last SpaceX valuation. I don't know exactly how like the ownership structure breaks down.
Yeah.
It also aligns with Musk's compensation plan that we talked about months ago, where it's
Mhm.
like he's going to be worth $1 trillion as long as he can do X, Y, and Z. The biggest one is jack up Tesla's market cap. I like Tesla, but I think I sort of like it on a technicality. If it's nuts and bolts comparing like which car company do I want to own, it's BYD.
Yeah.
Um, if it's which stock price do I think is higher because there's some weird M&A activity that's designed to make the world's richest man even richer, then I got to go with Tesla.
Okay. We're again on opposite ends. That's a good thing. But this is going to be really good fodder for our year-end hot sauce episode. See, I'll have to make sure to track back to this. See who has to pay up. All right, Madison, what's next?
Beating down mega caps, Netflix versus Meta.
I like
Netflix.
Netflix. I figured we'd align. I know your disdain for Meta.
I
I just think
Meta.
Netflix has gotten beaten down for things that, okay, it started with it missed earnings, third quarter earnings in October, and that chipped away. I think there was a 10% tax from Brazil that they weren't expecting, which, they probably should have, but supposedly is, you know, a one-time deal. That, weighed on earnings. But then the biggest thing is the uncertainty around its bid to buy Warner Brothers Discovery. And, the Warner Brothers board has voted to accept Netflix's deal, but it hasn't stopped Paramount, Skydance from trying to, um, issue a hostile bid that's much higher. So that's sort of been weighing on it. But I think once we have another earnings report, assuming they don't miss earnings, I think they report next week. Assuming they don't miss earnings again, and sort of allow investors to get back to seeing like, oh yeah, this is one of the, still one of the most reliable growth stocks in the world. And meanwhile, the stock is more than 20% off of its highs. I think there's no reason, just came off, record viewership for its Christmas Day NFL games and, Stranger Things season five, right? Was in its top 10 most watched shows ever, on the platform. There's a lot going for it. And hey, even if the Warner Brothers deal falls through, I don't know that they need it. They'll find something else eventually. They're doing just fine anyway. So Netflix, Netflix, Netflix for me, easy choice. I'll let you talk. You can talk about why you hate Meta.
I don't I don't hate Meta. They just keep getting handed opportunities and then whiffing on them.
Yeah.
Um, and I don't know, part of it's leadership, part of it is,
I think the
I guess.
metaverse thing, I can't
Well,
erase that.
so that's exactly right. Like this is I'm thinking of the Bush quote where it's like, fool me once, shame on you, fool me, can't get fooled again. Right? Where it's like, okay, yeah, no, they
Yeah.
got me a little bit with the metaverse because I could sort of paint a picture of where it works. Where it's like, okay, yeah, people are using screens more. People are going to be receptive to sort of a digital third space or a digital shared space. The thing is, if you had bought Meta based on metaverse hype back in 2021, um, you're up 64.5% since then in
Mhm.
5 years, so about 12% a year. So the returns are still there. Um, the AI, you know, they have like the biggest pool of sort of internet users on the planet. Um, Facebook is the internet in a lot of sort of like emerging markets. It'll come preloaded on phones. Like there's a huge opportunity, but you just can't trust that they're going to make the right calls or that they're going to be able to successfully monetize it. I think Google is doing what Meta had the sort of potential to do where they're commoditizing their AI models. They're making it available to like the internet using public as a whole, and they're finding ways to monetize that. I mean, Google sold to Apple, right? Like their Apple is going to be using Google's AI tech. Um, Meta just keeps whiffing. I think Meta continues to whiff. They become sort of an also ran in the AI fight. Um, Netflix actually produces a good product that people like. I think I think Netflix is the way to go. Netflix,
Yeah.
obviously, like if they end up because I think they just upped their bid to all cash for Warner Brothers Discovery.
Mhm.
Um, if they are in a knockdown drag out fight and they end up having to pay like $120 billion or something for uh from what 75 I think was their latest offer, maybe that drags them down, but at least they know how to run a business and produce things that people like.
Right. And I liked Netflix before this whole Warner Brothers merger was even a thing. If it just goes away, say that it gets caught up in regulatory hell for the next 18 months and just never gets approved, it'll be fine. You know,
No.
I, and as a someone who likes to go into movie theaters, part of me is rooting against it anyway, because Warner Brothers is one of the biggest movie studios, and I don't want to see Netflix just put everything on their platform and just suddenly a lot of the movies that we like going to are just are just in your house. I'm not a big fan of that. But I like Netflix regardless.
So I mean Netflix right now is trading like near Liberation Day prices.
Right.
Um
It's way
they
oversold.
Yeah, and a lot so they were 50% higher in July before that growth stock sell-off started back then.
Mhm.
Meta is they're still up almost 30% from Liberation Day lows. If that's sort of where the re-rate pricing goes, I keep looking at those numbers as being like the next sort of downside target. Um, I wouldn't be surprised if Meta closes the year down
Yeah.
at the end of 2026 while Netflix is up 20%.
Yeah. I agree. All right, let's quickly get through these last couple.
Small caps versus large caps.
Small caps.
Yeah, I
Not even
think
a
you already
debate.
basically said it earlier. Small caps, I agree. Tyler, just to reiterate, Tyler London has come on here a couple times, said small cap growth is supposed to be estimated to be over 20% this year, which is higher than large, more than double what large caps are expected to grow. And that has not been the case in recent years. Small caps have lagged large caps in terms of growth, but now we're finally seeing with interest rates lower, with administration in there that, small caps tend to be less multinational than large caps. So, a lot of their business comes in the US, with an administration in place that is pro, you know, America first. All those conditions are, friendly for a small cap, outperformance, which historically it does every 3 out of every 5 years, and it has not done so for like 5+ years now. I think it's time, and there's the conditions for it to happen are couldn't be better.
Well, and we talked a little bit about M&A activity picking up this year, or the expectations that it'll pick up this year. Well, what does that actually look like? It looks like bigger companies buying smaller companies. What do we see when we have an acquisition go through? The acquiring company dips because
Mhm.
they're out cash,
Right.
and then they've got to worry about the logistics of integrating a new company. And the company that's being acquired rises, right? If we're heavy in MA, interest rates are presumably continuing to come down. Uh, Good environment for small cap earnings, and then that sort of lagging performance. I think everything is set up for small caps to have a really strong year.
Yeah. No, agreed. All right. What's the last one here?
Last one, Bills versus Arizona basketball, more likely to win a title this year.
We had to put a non-investing one in there. So the Bills are the more pressing one. My beloved Bills play tomorrow in Denver. I mean, it's a tall task. If they're going to make it to the Super Bowl, they're going to have to do so probably on the road, three straight road games. I think no, I think definitely on the road because of the sixth seed. Uh, Step one was a big one. They beat Jacksonville on the road, barely. Now at Denver. I like the Josh Allen versus Bo Nix quarterback matchup, gotta say. And then could be at the Patriots. Um, Although the Texans are their defense pretty good. And then you got to win the Super Bowl. Tall task, but it's possible this could be the year. This could be laughably wrong in about 48 hours. Or sorry, 24 hours. Um, but but let's get to the other team we put in here. I put this in here. Your alma mater, Arizona, University of Arizona basketball is undefeated. They're killing people. Um, Long, proud history. They have won a national title, unlike the Bills. They've won a title back in the 90s. What do you think?
I think it comes down to how easy is this uh once they make the tournament, they're going to win 6 games in a row against increasingly difficult
Yeah, March Madness
competition.
is way more of a
Y-
crapshoot, that's for sure.
Yeah, I mean, like, the Bills need to win 3 or 4 more games, right? I think the NFC ends up dog walking whichever AFC team makes it. Um, I think NFC is just going to run roughshod over the AFC this year. I like Arizona. They're playing well. But we're in mid-January and the tournament doesn't start until March. There is, and even once it starts, like you said, total crapshoot. Like, I don't expect them to get Cinderella in the first round. At this stage, they are presumptively the number one overall seed.
Right.
They're not going to lose to a 16, and they're
Right.
probably not going to lose to like a 9 seed. But then you've strung together a couple of games. You're traveling a lot. Yeah, like maybe a 4 seed or whatever upsets you, or if you get through them, maybe a 2 seed, or if you get through that, maybe the 1 seed from the other one of the other brackets, right? Like, there's just so much that can go wrong. If I had to bet money on it, I would bet money on the Bills. We should have pulled the odds. I wonder if they even have
I
odds
know.
for.
Well, here's something just to embolden you a little bit with, yes, March Madness is a crapshoot, but one seeds almost always win the tournament. Um, this century, they're all the champions, but let's see, one, two, three, and four. All but five champions have been one seeds. So, for all the madness that takes place leading up to at the end, I mean, last year was all one seeds in the final four. That's only happened. That was only the second time that's ever happened. But one seeds, the dominant teams usually win. Now, it's not always the one seed, which Arizona would be now. But if you're a one seed, you have a decent chance. Now, I hear what you're saying though. Bills just need to win three more games. I would probably take the Bills in this, but it's close.
So I checked the odds while we were speaking. Both of them are around like plus 550, plus 650 for their respective
Wow.
title shots. So it's Vegas at least thinks that this is a good question or
I'm
a
going to do the smart thing. If you're taking the Bills, I have to also not jinx my own team. I got to take Arizona basketball. So I think we have the smart
so
thing
we're
as
both
to
jinxed.
support, to be good fans. We have to take
Oh,
this team.
oh, it's camaraderie, not it's not us reverse jinxing each other.
No, no,
Uh,
no, no.
yeah, I don't like the Bills to win. But it's just too long, too many games, too many upsets, too much heartache. Uh, I was at U of A in like 2001. So that's we're at 25 years of me having like deep a deep relationship with that basketball team. Um, they have not won a title since I became associated with the school. In any, actually, maybe in baseball. I don't know. I don't watch college baseball, but I don't think so. But yeah, I don't know. I think the persistent jinx is enough to stop them, even though I don't like the Bills. But I'll take your Bills. You take my Cats, and then
Yeah, that's the responsible thing to do. Maybe they'll both win. Could happen.
there's no way that's happening.
Okay, well, I think we've talked enough about all things. Thanks for joining us this week on Street Check, and we will see you again next week.